All right, guys, so here we are on Thinkorswim, and we're going to go ahead and take a look at, excuse me, some options here, some put options, and how you could go about selling some put options for passive income. I have, you'll see Apple was last traded at $150.70. And what we're looking at here is if let's go out to the expiration that's about a month out. It's a little bit more than a month out, so we're going to go to the 21st of October expiration. Today is September 16th, and we're going to look for an option to sell. We're going to assume that we already own, or that we're looking to get long 100 shares. Sorry. So the covered call, you already own the stock, and with cash secured puts, you are actually going to go out and place a bid to buy the stock by selling a put option. And so when you look at this here, you can see that these are all the different strikes. And so it really just works in reverse, like with a covered call. You hit the bid to sell to open a contract, and then you get the premium, and that's the maximum upside. For example, if you bought the stock right now and you sold the 160 strike, you're looking at 264 in premium. Now, for a cash secured put, let's take a look at Apple's chart actually, and I'll show you what's going on. So essentially, you can pull this up and look at any kind of time frame. This is going to be, I think, the 180-day time frame. Each candlestick is 4 hours. What I want to do is go to the 1 year, 1 day time frame, and you'll kind of see that you can get a different perspective in terms of Apple and where it's trading at, or where it has been trading at. Let me just maximize this, and you'll see, there's different indicators and stuff on Thinkorswim you can, put on here as well. But you'll see a primary level of support. Could be the $130 level, or 129 was the exact low. So you could essentially sell a strike or a put at the $130 level. That implies about $20 downside in the next month. Now the markets have been volatile. You'll see that Apple's been down essentially 1.1% today, and that's live trading as we speak in the post market here. So $130 strike, I mean, you could sell 135. As you can see, there's some support right here, 137 or 138. But if the markets do get rough and the S&P 500 takes a big tumble, a stock like Apple will be one of the primary stocks that are impacted. And so when you're looking at strikes to sell these against, I mean, you could go down to 135. But as you see, if you go down to 130 versus 135, you can see that there's about, $60 more in premium you're getting per contract at the 135 versus the 130 level. And so if we wanted to sell the 135 strike, for example, we're looking at about $188 as of right now for each contract. And so if you have 100 shares of Apple, that's $188 just for, or I'm sorry, if you're looking to get long 100 shares of Apple, I need to keep on remembering we're doing cash secured puts, not covered calls. So if you have the capital, that's, take 135 times 100, and that's how much capital you'd have to put up, which is $13,500. Now in return, you're going to get $188 at the current price. Now this is fluctuating. On Monday, obviously, the market's closed right now. We'll see where that opens up at. But you'll see it already defines your max profit on this trade. So your max profit in this case will be the premium you receive from selling to open that put option, which is $188, and then the max loss would be $13,312. Now the way they calculate this is you take the strike of 135, we can actually calculate this ourselves, and we can determine that the max loss that we could essentially get on this trade would be if Apple went bankrupt and it went to $0 per share. You take 100 shares times the strike of 135, and that's $13,500. However, we are getting $188. That doesn't include commissions. So when you do include the commissions, you're actually looking at $187.47. But we'll just assume no commissions on this. So we're going to take 188 minus 13,500. And what do you see here? You have 13,312. That's exactly what our max loss is. So it's going to be, if Apple comes out on Monday and says they're going bankrupt, highly unlikely, right? But the stock price goes down to pretty much nothing. That's your max loss, okay? So just something to keep in mind, because you're on the hook either way over this next month. If you don't close out the position, you're on the hook. And of course, if Apple does take a big nosedive, let's say this 135 strike that we're going to sell here, if it does in fact go below that, the put option will blow up in value. And right now it's trading at 190, but if you see some of these in the money put options, you'll see this one is about about a month out, $10 in the money roughly, or about 15 actually, if you look at the 165 strike and look at the amount of premium they have on this, $15.90. Now, that's what can happen. So you're talking about an option going from $1.90 all the way up to, $15.90. Now, in this situation, let's say you sell this put option here, you get the $188 or whatever, you're on the hook to buy the shares. What I would do in that situation, if it goes below that, I would just wait it out. Because you're going to get long at 135. If Apple goes down to 120 in the short term or something like that, the next thing you can do, and what we're going to discuss, is talk about the wheel strategy and how you can then sell a covered call at, the same strike or around there to get additional passive income. So you have to ask yourself, how much downside do you see Apple having? Obviously, the market's been down. But we're selling a strike right now that's $15 out of the money. You could even take a little bit less risk and get $124 for the next one. Not a huge amount, but you're talking something in terms of your portfolio. It's better than just buying the stock outright at 150. If you expect it to go down and you're bullish on Apple long term, why not sell a put option, get the premium? If it doesn't fill, right, and let's say the stock finishes above the 130 or 135 strike, whichever one you choose to sell upon expiration, then you can simply repeat the process. Perhaps this time Apple is a little bit closer to that strike price you initially sold at, and then you can sell one that's down even further out of the money the next month, or you could simply sell the 130 strike. And if the price is closer, like let's say Apple goes down to 140, for example, by the time expiration rolls around, well, the next month out, you can just roll that out. Essentially, since it expires worthless, and then you can sell another put option at 130, 125, whatever strike you want. And so that's really what it comes down to. And like I said, this is my preferred method of purchasing stocks. I think I mentioned that in the last video. I would much rather purchase stocks doing it this way and get the passive income than just outright buy the stock if I'm going in it for the long run, especially. Now, if I'm just trying to place a quick trade and make money from the upside, that's a different story. But if I'm looking at this from a fundamental perspective and saying to myself, would I rather just go at, buy the stock at 150 at market, or if I believe the stock is going to keep on going down, right, we can pull up FinViz and take a look at it. That's another charting software I use. We have the charts on Thinkorswim, but you can also take a look at FinViz and just type in Apple and see how it's been doing. See what the levels of support and resistance are. You'll see that this level down here, the 130 level, is probably going to be key. Do we bounce all the way down there? I don't know. You'll see that you have, some different lines and stuff you can look at, but it just depends on the market. I think personally there's a good chance we could see that level just because the market has been in turmoil. This was in June, so if we test those June lows again, 130 would be a level that we could see. So you kind of look at that during your analysis. The same thing if you have a covered call position. The stock, let's say, has been going down, but what's the chance of it rebounding and then your shares getting called away before expiration? Those are questions you have to ask yourself. You can look at the support line here, right? It touched this level. If you own this stock for a while, let's say you had some shares, you could sell a covered call at the 180 level if you expected to bounce off that. And sure enough, that's exactly what happened, or even 185 if you wanted to get way out of the money. But of course the stock is sold off since then, but that's something to consider whether you're doing puts or calls. What's the support and the resistance, and also what are the fundamental catalysts? It's not just about technicals, it's also about what is the company expected to do. What in terms of like earnings, right? That's one thing that can really impact options premiums. The reason for that is because implied volatility increases, and so although you get more premium for selling options right before earnings, that's also a very volatile time to sell options, and so you can definitely do so. But even though you'll get more premium for that because of the implied volatility increase, and we'll get into that in another video, you have to keep in mind that there's also more risk, and you're being compensated for that risk in the form of the options premium. And so when you're looking at that, you just have to keep that in mind, and always remember that the more implied volatility is baked into those options, the more premium you'll get, but also the more risk you take. And so that's compensating you for the risk that Apple makes a big move in the direction that you don't want it to. So that's a good way to look at it. Now we can look at another stock here as well. We don't just have to look at Apple. What I want to show you also, like if you're looking for something that's maybe a little bit more volatile, right? Maybe you have a higher risk tolerance. It really comes down to what you're trying to accomplish. But Palantir options have a lot of implied volatility because the stock is very volatile. This stock in particular is not uncommon. I can show you the chart on it, to move 20 to 30% on earnings. I've seen it happen. So if you can stomach the risk, you can get a lot more options premium. And I'll show you an example of this in just a minute. But let's look at the chart here for Palantir. and you will see that this is the 1 year 1 day chart. And so just kind of looking at this, I mean, you can see that there's a big gap down on earnings. So you could have sold a put it, thinking it's going to hold this level. I actually did this myself, and I got absolutely hammered on it. Sell a put at $8 per share, $9 per share. If you think this $10 support level or whatever was going to hold, sure enough, it did not, and the stock gapped down. So what happens in that situation? You get long the stock at $9, $10 per share, or whatever. And essentially what happens from there is that, if the stock's at $5 or $6, well, now you can sell a covered call against it. But the question is, how much has the stock sold off? And so, as you can see, it's just super volatile. I mean, we got back up to $11 per share, and now we're all the way down to $7. You can even look at a longer-term time frame. If you look at the 3-year weekly chart, each candlestick is a week. We got up to a high of 45, and now since the market's been crashing, appetite for growth stocks has dissipated. And so, ask yourself over the long run if you like this stock, if you would consider adding to it. But just an example, right? You don't have to do this against just dividend stocks. You can, and it really comes down to your risk tolerance. But let's say you're a younger investor, you want to take more risk. You see that Palantir has sold off dramatically. You can sell a put at $6 per share. Now, this is about a month out. Today's the 16th, and that's the 21st. And so let's go ahead and sell this $6 put. We're going to say that we're not going down there. Now, you'll see that you get 9 cents in premium per option for that. And what we're going to do here is do the math on, let's say, about the same capital requirement as Apple. So we're talking about $13,000. We're going to go, or I think it was $13,500. And then you just divide that by the share price of $6, or the exercise price, the strike price, I'm sorry, at $6 per share, and we get 2,250 shares. And so we can actually sell 22 contracts. And so let me increase this here to 22 contracts, and you'll see what I mean. So we're selling the Palantir 21st of October 2022 expiration. So if Palantir is above $6 upon expiration date, nothing happens. We keep our, we don't even have to, our cash just goes back into the account, and then we keep the premium. If it's below $6 and we hold this option through expiration, then we get long at $6 per share. In the meantime, though, you're selling 22 of these at a price of 9 cents. Let's see how much we get. And you're going to get $198 for this. And so already the same capital requirement, it's, you could argue it's roughly percentage-wise, maybe I'd have to run the numbers on how much it's out of the money. But to see $6 Palantir, I mean, you see that was a level that we bounced off of on the chart here. The low is $6.44. And so you could even sell a strike at that support level if you want to, at, let's say, $6.50. If you want to be a little bit more risky, you can do it at $7. And it looks like they don't even have a $6.50 strike on here. And so you have $6 and $7. And I thought they might have had the $6.50 strike, but I guess not. So looking at this, though, you see the $7 strike. You want to take more risk, you're going to get more premium. Let's do the math on this. So the same capital requirement of $13,000 divided by $7 per share. That's the capital commitment price. If you don't think it's going to go much lower than that, and you're okay with getting along with the stock, why not do this? Because you're going to get paid for it. And so that can offset the cost basis of the stock that you own. And so we have 18 contracts here that we're looking at. So just doing the numbers, and I'll show you what I mean as an example. So what we're doing here is taking the strike price of $7 per share, and we're saying we're going to commit the same capital as Apple at that 135 strike. So we'll just say 13,500 divided by the $7 strike, and we come up with 1,900 shares, actually. So let me do that again to make sure. I believe that was correct. 13,500 divided by $7 per share. And we have 1,900 shares we can purchase, which means we have 19 contracts that we can sell to open. Now, for each one of these contracts at the current price, the bid price, 28 cents per share, or per contract, I'm sorry. That's going to represent times 100 is $28 per contract. So you take 19 contracts sold to open times $28, what we will receive for each one of those sold. Kind of cool to think about, right? Like if you had a business and let's say you were selling something like a product online, and you were selling it and making $28, and you sold 20 of those. Well, hey, there 19 of those. That's pretty good. So let's see how much we get here, right? So we get $532 for this trade. Our max loss, as you'll see once again, you have the $12,768 in total capital, right? Or that's the total max loss. I'm sorry. So $13,500 in total capital. And then we subtract the premium, which is $532, and we come up with $12,000 $968. And I think I did that wrong, and I definitely did, because what I didn't factor in, let's see here. Well, you get the idea. So basically, it's the break even. You take the 12,768, just add the premium of 532 back in, and you'll see that it comes up to, I guess I did $13,300 by accident, but nonetheless, you get the idea. Okay, so we're selling 19 of those contracts. And the reason it came up to that, actually, I just realized, is because that's the maximum you have to round down. So that's the actual capital committed on this trade was $13,300 minus the premium, and then your max loss would be, if Palantir went to zero, $12,768 would be the max loss. So the total credit after commissions, in this case, it looks like $521.88 is what we have here. And so essentially at this point, you can send this if you want, and then once you send that, the money will show up in your account, and you can withdraw those funds after the 1 business day settlement period. If you have margin on your account, you can actually, a lot of brokers will allow you to withdraw those funds the same day, or you just keep the money in the brokerage account, and then you can actually just keep on stacking that cash, and you'll have more cash down the road to actually sell additional contracts when it comes to, you know, cash secured puts and covered calls. And, you know, you'll notice a theme here when I'm doing this, right? The main theme you have to keep in mind is that I'm selling out of the money. So I'm placing bids, right? But instead of just placing a bid, like a lot of people will place that bid to buy at one, you know, let's say for this one in particular at Palantir, they might want to buy at $6, $7 a share, but they're not thinking about how you can get paid for that as well. And part of it is, you know, they want the order to execute immediately if it hits that price. They don't want to have to wait until expiration where there's uncertainty with the option. And the other part of it is, essentially, if you're looking at like options in general, a lot of people don't even really know much about options, to be honest. They know how to buy and sell stocks, but they don't realize this is possible. And so that's why I bring this up, because it can be really helpful no matter what stock you're looking at. I mean, there's actually a strategy we're going to talk about, which is called the double dividend strategy. And this strategy is essentially selling covered calls against positions that you own, and then also collecting the dividend as well. So we're going to get into that here in another video, but I hope this kind of helped, guys. In the next video, what we're going to be doing is actually taking a look at the wheel strategy. Now, the wheel strategy is going to involve selling covered calls and also selling cash secured puts, but I'm going to give you some examples, and I'm going to show you how this works exactly. I even have a spreadsheet that I've been keeping track of, and so I'm going to you know, have that as well and show you guys that, so that way you can get a better feel for how this works and everything. So the next video will be the PowerPoint presentation on the wheel strategy, and then we're actually going to go into the spreadsheet and the Thinkorswim tutorial here in the following video after that. So you'll see that lesson next up. And beyond that, guys, hope you enjoyed this video. Let me know if you have any questions. So, you know, if you are signed up for this membership site, you should be able to email. You can also go to the chat and everything that we have. If you're not signed up for that, just let me know, send me an email, and I can get you set up for that. But nonetheless, guys, hope you enjoyed this lesson. Let's get into the wheel strategy, and I will see you in the next video.